Hi, my name's Andres Ibiza, and this is the DuPont analysis I conducted for Southwest Airlines. I compared the company against their primary competitor, which I would consider to be Delta, as well as the airline industry as a whole. And I started with one basic question. It was, how well are these companies recovering from the pandemic and the slowdown in global travel that resulted from it? Before I dig into any of the financials, first off, I want to go through the basics of Southwest's strategy as a carrier and what their enduring competitive advantage is that sets them apart from other airlines, Delta included. Um, Delta is more of a full cost carrier where they have first class versus coach sections of the airplane. Southwest is very no frills in their experience. There are no assigned seats whatsoever if you go on a Southwest flight. There's just boarding groups, and there's no first class section at all. And so, uh, basically, Southwest pioneered the low cost carrier model that's now copied and, in some cases, can undercut Southwest with an ultra low cost carrier model. There are still competitors on both sides of Southwest in terms of bigger carriers and smaller startup carriers as well. But what really sets them apart generally as well, what really sets Southwest apart from other airlines was the effectiveness of the company's responses to COVID-19. Uh, from the beginning of the pandemic in March 2020, the company introduced pretty strong cost cutting measures, including cutting executive salaries, grounding planes. One of the more interesting projects they did is they started engaging in more sale and leaseback transactions to take planes off of their balance sheet but retain the right to operate them. Um, and so it was basically all hands on deck to cut costs and raise revenues. And so some of those responses included raising debt in capital markets. And Southwest operated with very, very low levels of debt in the first place compared to the airline industry average. And they took the opportunity provided by grounded planes to also begin flying to more destinations with their point-to-point route system. As a Chicagoan, I'm happy that beginning in early 2021, the company started service at O'Hare International Airport, and so it's nice to be able to fly out of O'Hare instead of Midway, which was a smaller secondary airport in Chicago they previously flew through. Still, even though some of the financials are beginning to recover and Southwest nearly broke even in terms of net income at the end of 2020, the passenger load factor is a really important indicator of how much volume the airlines currently have. And basically at the end of 2020, the load factor was still down to 52% from a previous high of 83.5%. And so the early signs are encouraging as far as the company's response and their current financials, but that still remains to be seen how the recovery will continue to unfold for the airlines. Southwest's current strategy remains sound for the current environment because they have a really good niche with their premium economy fares that are going to do well with tighter corporate travel budgets, or people just not traveling at all because of the existence of Zoom and online education, for instance. And so there's going to be a lot of flights that maybe could have happened before that will never happen because they'll be substituted by video conferencing. And so, with being a premium economy provider, where there still is a standard of customer service with no baggage fees on the first two bags, and things like that are customer-friendly airline practices. Overall, from the DuPont analysis, even with the additional debt that the company took on during the pandemic, they still have much lower debt levels than their competitor Delta, and are in a competitive position for future growth. Delta's net profit margin consistently outperforms Southwest, but Southwest remains in a superior financial position in terms of gross profit margins, liquidity, and the value of common equity. Delta's most recent 46.5% return on equity only compensates for the company's massive decrease in common equity in 2020, which we will get to in a future slide with a graph showing the drastic change that occurred in Delta's value of common equity. Southwest's net profit margin after tax has been decreasing over time, generally speaking, from 15.6% in 2016 down to 9.5% in the most recent quarter ending September 30th of 2021. Southwest should certainly explore new strategies to boost the net profit margin to more competitive levels and more in line with historic averages for them pre-pandemic. Until 2020, Southwest consistently collected accounts receivable much more quickly than Delta, with a collection period of 13.5 days in 2019 compared to 20.1 days at Delta. But on average, Delta turns through inventory at double the rate of Southwest. Likewise, Delta keeps an average of half the day's inventory that Southwest maintains. Interestingly, many sources cite rapid gate turnarounds as a source of improved fixed asset utilization. Supposedly, mastery of fast gate turnarounds improves fixed asset turnover relative to competitors because each plane generates higher average revenue than rivals. Yet, since 2017, fixed asset turnover at the two airlines has remained nearly identical. Overall, total asset turnover at Southwest is almost the same as total asset turnover at Delta. Moving forward, Southwest should explore options to restore collections and inventory to 2017 levels. Southwest and Delta consistently demonstrate two very different capital structure choices. Delta operates with much higher levels of debt on its balance sheet. In the most recent quarter, ending September 30th, 2021, Southwest operated with a 1.1 long-term debt-to-equity ratio versus 9.8 at Delta. Due to the higher risks associated with this leverage, Delta's weighted average cost of capital is roughly between 7.8 and 8.8% versus 6.8% at Southwest. So Delta's cost of debt is consistently 4 basis points higher than Southwest. Likewise, Southwest beta is much more stable at 1.17, closer to the market at 1, versus 2.09 for Delta. Theoretically, all else equal, Delta's greater utilization of debt financing should boost return on equity relative to Southwest. But at this point, any improvement in return on equity is from a giant drop in common equity at Delta in 2020. So in this chart, the purple line with the circle reflects the values for Delta Airlines. And so in December of 2019, the value of common equity stood at $15.368 billion. And then it decreases dramatically. So that most recently the company has a total market cap of $1.261 billion. And so it went from like almost 16 billion to, less than 2 billion. So that's a pretty huge decrease. Whereas the purple square line is the line for Southwest, which is this one here. And so that's remained pretty stable over time, and there wasn't a dramatic decrease in Southwest value of common equity in 2020. And then also, at the same time that its value of common equity decreased, it took on a much greater amount of debt than Southwest as well. To keep this section short and sweet, Southwest has a lot of cash on hand relative to the airline industry average and relative to Delta. Southwest Airlines pursues a low-cost provider strategy, and a company known for its cost-reducing incentive systems and culture. Southwest successfully reconfigured the established business model for commercial airlines, allowing the company to offer customers much lower fares than the competition. The COVID pandemic shifted the competitive landscape for the airlines as cost discipline, discounted fares, and flexible customer policies to stimulate traffic became the norm across all the airlines. Given Southwest's long track record of success with its current strategy, Southwest should continue a defensive approach to protect its market position and ongoing competitive advantage.